What's up, guys? So it's been a few weeks since my last post, and I wanted to update you because there's been slow changes, but changes nonetheless. The first big thing is that I am now actually more active on locals. I already got that set up. I had it kind of, I signed up for it, but I really didn't do anything in locals. I didn't have the logo or anything like that updated. So I'm starting to post. I actually just did a post on the markets, and that's on locals. You don't have to. I know a lot of times in locals you have to pay for the content, but a lot of the content that I'm sharing right now is free. Okay, so it's not paid or exclusive content. It's free. It's for all of the all of you guys who have been following my channel, and it's been a small channel. I mean, I only have 50 followers right now. Okay, but it's for you guys. So follow me on locals. One of the things I love about locals is that they're not censoring, and I hate censorship, guys. Okay, I'm very much for let people speak. If you don't like it, turn off the TV or just don't pay attention to them. That's pretty much how it goes. That's my take on it. I don't like people telling me what I can and cannot say. So I was very hesitant when I was starting to use Discord, and so I've unplugged from Discord. I'm not using that. I don't like what they're I don't like their model. I don't like their censoring. I don't like any of that stuff. So long story long, no more Discord. I am on Telegram, and I am now on locals. Okay, but locals is going to be where I'm going to build this community. Now you guys know. I was in Wall Street for quite some time professionally. And for those of you who've been following the channel, you kind of know a little bit more about me. So I want to build a community right there on locals, talk about the markets, talk about things that I'm, things that I'm in, things that I'm not in, and really build the Wall Street money report right there on locals. So follow that. Okay. Follow me if you want to get more of these updates. I got a lot to talk about, but again, I just wanted to give this update because, it's important. Okay. I know I've been kind of MIA, I'll do a video and then I pretty much disappear, and I'm, pretty much disappear for a few weeks, few months, and then another video pops up. I've been wanting to be consistent on these. Okay. I trade in the markets every day. Okay, this is my bread and butter. This is what I do for a living, but it's not all I do for a living. I'm not a day trader, guys. I don't, I'm not just handcuffed to the markets, for the whole day. I'm not doing that. Okay, I am, I'm trading, but I'm doing a lot of swing trades. I'm basically doing positional trading. Okay. I'm adding to my positions. I'm scaling out of positions. I'm building long positions, holding them for as long as I can, for days, weeks, months, even more than a year. If the stock can just run up like Apple, that's one that, I held for a number of years, and trading in and out of it. It's positional trading. This is what I learned to do in the banks. I added my own little twist to it when I started doing it myself. And so this is what I do. So I'm not looking at the markets. As a matter of fact, the time that I'm busiest is in the evenings. When the market closes, that's when I'm kind of going in there and I'm checking the charts. I'm reading the financials. I'm looking at the economic data, and it's really crunch time after the market closes. Then I set my orders. I set my levels. I set my prices. And that, what do I need to start scaling out of? How much of my portfolio is allocated in one specific position? Should I be 20% of my portfolio into this one stock? Should I lower it down to 15, 20, 15%, 10%? Should I start a new position? How much? 5%? All of these percentages, all of this portfolio management, this is what I'm doing. And this pretty much takes place when the market closes. Okay. But again, this is not what I'm doing. Well, yes, I am doing this full time, but on top of that, I'm also a parent. I homeschool my daughter. Okay. So during the day, I'm actually homeschooling her, helping her with her studies, and I'm pretty much, molding her education. She also has tutors that I brought into the fold, private tutors that tutor her, and It's a very tailored education that I'm providing for. And I love doing this. This is something I wanted to do ever since she was a little baby. I wanted to give her the education that I wish I would have received. Not that it was bad education, but, really an education to think three-dimensionally, an education to even now she actually is she has a small portfolio that she even manages, and she's only 8 years old. Okay. But she understands how to look up a stock, how to see if it's under I'm getting tongues out here, but if it's being accumulated, if it's being distributed. She understands these basic things, and it's not that hard. Okay. It's not that hard. Wall Street makes this so complicated so that Main Street thinks that they need to have a financial advisor to understand these things for them. And even most financial advisors don't even understand these things because they don't do any of this. All they do is, they pitch a product, they sell you a plan, and then it goes off to the portfolio managers, and they pretty much, buy and sell whatever your mutual fund is, whatever you're in. This is pretty much how it worked. I was in this business for a very long time. I started my career interning at Morgan Stanley, and doing coffee runs and really understanding how the business works. And it was a great education. The real world was a great education. Okay, understanding, seeing all of how everything works. It was great. But what I want to do is demystify all of that stuff, to teach you guys, to help you guys understand, that how things are moving, how things are shifting. That's very, very important. That's what I want to do. And that's what I am going to do. That's why I say, follow me on Locals. And that is it. That's where I'm going to start building the community. And it's not going to be like how I had my Discord. And then, that pretty much just ended. And it's like, what do we do now? No, that is where I'm going to build everything. That's going to be the community hub. So those of you who are following my channel, who like the content and want to engage in the conversation, that's where that's where you're going to find me. I'm not really going to be answering any comments on YouTube. I'm not going to be doing that. Okay. There's a lot of scam. There's a lot of spam. There's a lot of nonsense comments, negative comments. I don't have time for that. My time is very precious, very valuable. And I want to make sure that time is going towards, the people who want to learn, people who have real questions. Okay. Not just negative people who are just kind of going to take up my time. That's, it's not fair for me to give them attention when that could be helping some of you to say, hey, wait, what do you think about this stock? And really bringing an education to the community and getting that engagement. That is going to take place on Locals. Okay. So, link will be in the description, and, we can kick it off there. So that is like the long introduction on, what's been going on, what have I been doing, and what I want to do. So as I get these videos going more and more, and again, balancing the schedule could sometimes be tricky, but I will be on Locals. That's where, you can, hey, I haven't seen you. Can you haven't dropped a video. What's going on? That's where I'm really going to be doing it. I may not post a video, but I may post a chart. I may post, hey, look at this, look at that. This is what I'm doing. I want to put a watch list up there for things that I'm looking at and share with my community. So, the goal is to do a video once a week. That's the goal. Okay. But the bigger priority on all that is to stay active on Locals. Okay. Answering questions or doing little reviews or whatnot and bringing that in. Okay. So a lot of this stuff is still in the mix, guys, but I did want to do this video and let everyone know in the beginning that I am now building up that Locals community, and you all are welcome to join. Okay. So, yeah. All right. That's that. So, the other thing I want to talk about in these videos, guys, these are not going to be very polished videos. Okay. I'm really not going to edit them. So you're going to have a jump cut. I really don't want to spend time doing that. Okay. I don't really enjoy editing. Okay. But I do enjoy making videos. But I don't want to have my time trying to polish these videos. So it might be a very raw video. I might be stumbling on some of my words, like I normally do. Okay. When I get really excited. but I want it to be authentic. Okay. I want to just basically have this be a place where I can vent, a place where I can just kind of, unload my thoughts and share them with you, and just put it out there. Okay. Just raw, unfiltered, and very authentic, very honest. And it is what it is, just like as it is. Okay. Just authentic, not polished, not edited, not clean, just what it is. Okay. That's how I want to do it. So let's kick it off talking about, this was a very interesting week. Okay. You had a surge, and, I really want to talk about that in this video. Okay. So now that all the introductions are pretty much, have been, broadcasted, announced, whatever, let's get into the meat and the potatoes of this video. And let's talk about what my take is on the markets. Okay. Now, everybody was excited. I saw a lot of excitement in the markets. Everyone is now in buy mode. Okay. And they're preparing for the great Santa Claus rally to come to the market and, basically, just continue the rally going. The market pretty much is back in business, as a lot of people are saying. That's what we're hearing. And now we have arrived into December. Okay. Now, the last video that I did a few weeks ago, one of the things that I always mention in my videos is the manipulation of the markets, primarily by the Fed. Okay. The Fed is always behind these movements because we have one man who is in charge and pretty much controls the markets. Okay. And this week, that man spoke. And this man, Jay Powell, sent the market up a good 700 points in less than an hour. And everyone pretty much jumped in, or they took it as a signal that, hey, it's now time to jump in and start buying. But here's the thing. Okay. We all know it's been a pretty bad year for the markets this year. I've been in this business for over 20 years. And one thing that I've noticed is that every time we're in a bad year, when you hit the last quarter, Wall Street will do anything to rally the markets. Okay. Now keep in mind, these rallies, they're not fueled by Uncle Bob, Aunt Mary, your friends down the street. They're not fueled by me and you. Okay. The real buying and the real selling, the real rallying of the market is not Main Street that's moving the markets. It's large institutional money. It's investment banks. These are the people who are really pulling the strings, and they're making the market dance like this. For those of you who watch my channel, you know that the way that I trade is by following the institutions, the big money movement. The large institutions are why markets ultimately go up or they go down. That's it. End of story. Okay. The market does not move without large institutions. I don't trade penny stocks. So, for those of you who do that, that's not what I'm talking about. The S&P 500. I'm talking about, Apple, Google, all of these stocks that we're all very familiar with, Microsoft. The institutions are putting their money in these things, and they're the ones who kind of take it off. So, but again, now we are in December, and here, let me pull this up because I want to show you guys here. Let's see here. Here we go. Biggest Wall Street banks are slashing bonuses by as much as 30%. Okay. 30%. So we've had a terrible year. Bleak expectations, okay, for banker bonuses rapidly proving true as a slump in deal making ends the industry's war for talent and firms regain the upper hand in setting pay. Let's see here. Here we go. Wayne plans to cut bonus pools for their investment bankers by as much as 30%. 30%. Okay. That's a big deal. And this is where we're at. Okay. We've had a terrible year in the markets. And so now what are these investment banks? What are they thinking? And it's very easy. Okay. Come December, the institutions are thinking about what everyone in Wall Street is thinking about come December, and that's bonuses. Okay. Again, guys, I was in this business for a long time, and I'm still in this business, not professionally, but I worked for a large bank in the equities division. And once December rolls around, you're talking about bonuses, total office bonus payouts of, $2, $3, $4, $5 million. Okay. This is in the millions. Okay. These types of bonuses are what's at stake come last quarter in December. Money is on everybody's mind. How much am I going to get? How much is that bonus? And people are really biting their nails, trying to see what is that paycheck going to be? What is that bonus check going to be? And this is where that Santa Claus rally comes from. And now we are here. We're at the end of the year. The bonuses are at risk, and you have Wall Street thinking that it's going to do, everything that it can to finish out the year with as large of a bonus as possible. Okay. We're getting to that last quarter earnings. And my take on all of this is that the timing is perfect. Okay. You have earnings, you have the end of the year. And we all know, by the way, how earnings work. Okay. This is where they play the beat the market estimate by a penny. Okay. They always beat the market by a penny. And that's easy enough to get the market rallying. But let's think about what else is happening. Okay. And this is what I think a lot of people aren't kind of connecting the dots. They're not really looking at, and it's bonds. Okay. They were being dumped. Yields were going up, and the market responded by moving lower. Since January, the market has it's been moving lower, been selling off, and it was relentless because it wasn't a fast and a heavy quick selling. It was a steady sell-off for weeks, for months. Usually when you have a big sell-off, you get a great big crash and the market collapses a good 15, 20, 30% in a few weeks. And that's it. It's over. Okay. That's it. It got knocked out, and the damage is done, and the rest of the year kind of crawls back up. But this one, you're talking about 40 weeks of selling. Okay. The S&P down a good 27%. When it bottomed. I know because we were short the whole ride down, and it's not until this week that I actually covered a lot of my short positions. Okay, but it's been a bad year for a lot of the big investment banks, and now they have the opportunity at least to get out of the year with good bonuses. And the idea here is actually very simple, guys. Wall Street has to figure out a way to financially orchestrate the markets. And how can they go about doing that? Well, you guys know that the S&P has roughly 8 major sectors, okay? And you have, not major sectors, 8 major tech stocks, okay, that pretty much move the entire index. You have Google, you have Microsoft, the usual suspects, that everybody knows, everybody loves to buy. Okay. And those institutions, they know that if they can control those stocks, you can theoretically control and move the market. Okay. So they can somehow keep the S&P up towards that 200-day moving average, getting closer to that last quarter. You use earnings season as a way to give it some gas and get it to that point. Then you're going to reach that point where you finally, tip that 200-day moving average. And on that day, Powell comes out and speaks, and he says what the market wants to hear. And now you have, again, perfect timing to get a nice rally and take the market above that 200-day moving average, especially when the shorts start covering their position in the tech sector. And that's exactly what happened. It was very well calculated. And now tech is very important in all of this financial engineering, because you can't get the market moving unless you get those tech stocks going. But tech stocks can't move without yields, with the yields being high. High yields, they're not going to do any favors for tech stocks, which is why you had a lot of institutions that were shorting a lot of the tech stocks. Okay. But if you noticed during earnings season, you started to get movements in those yields as the institutions started to enter the bond market, and they were quietly buying bonds. And the reason that they were buying these bonds is to start setting the stage for tech stocks, okay, which benefit and they react to the low yields. So these guys, Wall Street knows that in order to get the S&P over that 200-day moving average, they needed to get the tech stocks in play. And that's exactly what happened. And it was just like they all met at a perfect intersection, and Powell was there to pretty much blow the trumpet and get his troops right over that 200-day moving average. But it was the tech sector that really drove the S&P straight through through that 200-day moving average. 37 million shares were traded in the last 15 minutes, guys. It was a frenzy, okay? You had massive short covering, and that was the frenzy. It wasn't just all short covering, okay? But you had a lot, and that is what helped to push that S&P over that 200-day moving average. But we have a problem here, okay? We have a little situation. We know that what we're looking at is not going to last if the market can't hold. The S&P, actually, let me load up the, let's go back to our browser window here, okay? And there we go, okay? Here's that S&P, guys, okay? Now, the S&P has to hold and close above 4,000, okay? This is pretty much where you have that 200-day moving average, the black line, okay? It has to hold above that, and it has to close above that by the end of the month to maintain this momentum, okay? And my take is that you're going to see them really try to continue to move the market up and get it above that 200-day moving average as high as they can get it up. And in the process of moving the market up, you're going to see some real volatility in the next few weeks. I mean, on Friday, we opened up down 400 points. Okay, so there you go. The volatility is now starting to kick in, but we're going to see that these next few weeks. Okay, but in general, they're going to try to keep this market going as long as it can. To get into that Christmas rally, to get into that final week of the Santa Claus rally, okay? And after that, that's when we're gonna get to the new year, and that's when we could be faced with a pretty big sell-off, okay? Because all of this engineering that has taken place, unless inflation completely disappears, and there's no possibility of inflation fears rattling the market, then we could, then of course we can continue moving higher if the market is pretty much done with inflation. I don't buy that, but that's as long as inflation is there, you're going to continue to have this boogeyman in the market, and I don't see that boogeyman disappearing, January. Okay, you see the market, guys. It's like a chess game, and the players, if you're playing close attention, they move. They kind of move in stages, okay? And they move sectors up and down. One sector has an effect on another sector, and the other sector has an effect on this sector. And the yields have an effect on tech, and so on and so forth. And everything, one affects the other, okay? So one movement affects the other, and the money is always rotating. The money is always rotating around, okay? Right now, you're seeing a lot of strength in a lot of these old value stocks, the Johnson & Johnsons, the commodity kind of stocks, Kellogg's, General Mills. You're seeing a lot of the Dow stocks that are pretty much leading, okay? Whereas tech, that's been getting destroyed, okay? It's been selling off. So the money is rotating because these, the PMs, the portfolio managers, they have to, be invested in the market pretty much at all times, okay? There's no point in really being in cash. So the money flows from one area to the other. And again, one sector affects the other. And all of these changes, this is exactly why I say all of this movement, all of this activity amongst the institutions is going to change the dynamics that we have ahead for us in January of next year. Okay. That's where I'm at. What's going to happen in January. Okay. Because all of this stuff is going to, that's where we're going to find out exactly if all of this was real or fake or whatnot. A lot of people are saying this is a bear market rally, which I happen to believe it is. Okay. Nonetheless, I've covered, good amount of my shorts, because, it's uncertain yet. Okay. But you have people who are jumping in, and, no one really knows, what's really going to happen next year. Well, the players are letting you know. Powell is saying that he might not push the interest rate as hard in the future because of housing inflation and goods coming down. So now he's saying that he might not do it. He might kind of ease up a little bit and not push the rates as hard as he was, thinking about doing it. And that is when the market took off. Okay. Remember last time that Powell said all of this, the market drove up a good, 1,500 points. And then, of course, it gave it all back. But yesterday, he tried it again. He tried that same tactic again. And that's how the rally got started. And again, as we got to that 200-day moving average, the institutions came in right behind him, and 37 million shares in 15 minutes. And there you go. Heavy institutional buying, heavy short covering. And boom, we're right up through the 200-day moving average with tremendous volume. Okay. That was on Wednesday. Okay. But what happened on Friday? Okay. Well, today we came in with the volatility. Okay. You had a pre-market drop, 400 points, because of the wage reports. The wages came in and they were really hot. And now this is, this really isn't any surprise, honestly. We've been having hot wages for the past, 8 months or so. That's nothing new. As a matter of fact, that's where you can actually see the real inflation happening in those wages. But I don't want to go off there. Let me stay focused here on the markets, okay? We are here in December. And what do you have in December? You have those bonuses. Last year in 2021, bonuses were like 45 billion. That's with a B, okay? December is a huge month. It's a big month for bonuses. And everyone on Wall Street, from the institutional traders to the analysts, they're all excited, and they're all, trying to get those as much as they can out of those bonuses, because it's pegged to the market, okay? For most of them, it is. And so, you usually get a rally, okay? One of the most mystifying things about Wall Street is the analysts. I kind of want to stop here for a second and talk a little bit about this, because this is important. You can't understand what's going to happen in December unless you understand the analyst, okay? And the analysts, they are able to move markets, okay? Now, most analysts are actually terrible stock pickers, okay? But one of the most, if not actually the most powerful tool that an analyst has is the power of recommendation. Okay. The power of recommendation. Analysts have the authority to give official buy and sell recommendations on behalf of the investment banks. Okay. Now, a very common misconception among the public when it comes to these recommendations is that the investment banks are indeed buying or selling based on the recommendation of their analyst. And that's a huge misconception. That's just not true. Okay. The reality is that an analyst could make a buy recommendation in a stock that the investment firm is liquidating and selling, and vice versa. Okay. The opposite can happen, but people don't understand that. They think that an analyst recommending a stock means that the brokerage is buying it. And sure, sometimes the brokerage can be buying the stock, or sometimes they could be selling the stock, okay? Or sometimes they're just not doing anything at all with the stock. It's just a call the analyst is making with no real, with no real buying or selling behind it, okay? Now, to illustrate an example of this is the collapse of Enron, okay? Now, if you're new to the market, you're going to want to do some research on the whole debacle of Enron, okay? But right before that stock collapsed and it went to zero due to all the massive fraud and the all the financial irregularities that were going on, right before all of that, the majority of analysts that were covering the company, they were recommending it as a buy. Okay, a good amount of the analyst, a good amount of the brokerages that the analyst represented. They didn't own the stock though. They were not even buying it, but the analysts were coming out and they were putting strong buys and buy recommendations on the stock the whole way down. And as a matter of fact, I think it happened. I think it happened that it was something like 10 out of 15 analysts were actually, they had buys or strong buys on it. So the majority of analysts were actually recommending to buy the stock. But I believe that a lot of the institutions, they were out of the stock before it collapsed. Okay. But the analysts were saying, they were still recommending to buy it. And if you were Uncle Bob or, the guy down the street watching CNBC, watching the stock fall, and the analysts recommending to buy the stock, a lot of those people, what did they do? Well, the public, they either bought or they held the shares as the whole thing was basically going down. So long story long, the analyst, what they say is not necessarily what is going on, okay? But it can influence the market nonetheless. Now, I don't want to go off too much on a tangent on the analyst, but I do think that when it comes to analysts, a lot of people really give them too much credit, okay? And now getting back on track here, just kind of understanding that, okay? What I'm thinking that may be happening in December, I believe that you're going to see a continuation of a rally, or at least a strong attempt to keep it going at the hands of the institutions and their analysts, okay? Especially with the earnings and the famous beat the street by a penny game, which again, guys, that's basically when the companies come out and they say they beat the expectations by a penny and the market gets excited and it's a big surprise and you get a rally, when in reality, again, something most people don't know is that many times these companies will actually project lower earnings than what they're really expected to get. So then it's easy for them to beat their own expected earnings. Okay. So for example, if your expected earnings are to earn at least $1 a share and you surprise with $1 and a penny a share, well, you beat the street by a penny. And well, if you, most likely, if you know that you're going to earn $1 and a penny, you just make sure that your expectations are lower than that, okay? So that when the announcement comes, you beat the street, okay? So you set the bar lower than what you're actually going to hit it at. And, I'm not saying this goes on all the time, but there's a lot of games played on Wall Street that people just are not familiar with. And they don't know how many of these institutions financially engineer these prices. So my personal take is, look, guys, this is what I see, okay? Let me adjust my chair. I feel like there we go. Sorry. I need to adjust the chair because it keeps falling. I guess the gas or something like that kind of slowly gets let out. Great chair. Herman Miller's favorite chair. It's a lifelong chair, but anyways, it gets a little low. Let me get back on what I'm talking about, guys, okay? Again, I just want to make these videos totally unscripted, guys. Okay. I just want to just download these thoughts straight into the it's straight into the video, and you guys can, take it for what you will. It's just like a live diary reflection. Okay. A vlog, whatever you want to call it. So look, guys, my personal take on what we're going to see in December is that this is going to be a December where the analysts are really going to be active this month, and they're going to be trying to keep that market going higher via earnings, via recommendations, and anything they can do to get people excited to buy stocks, get the public involved. Okay. And here is where I want to close out with. Okay. I've already explained to you guys how the analysts work and kind of what goes on, but let's wrap up this video because I know it's getting a little on the lengthy side, but hey, you know what? It goes until it goes. All right. But the way I want to wrap up the video is, why? Okay. Why do they do all these things? Okay. And the bottom line is compensation. Okay. I've already kind of explained to you, what happens in December, how people are just, really working hard for those bonuses. They really are just amped up for them. And it all comes down to compensation. Okay. Now, this isn't the case for all analysts, but for many of them, it is the case. Many of their bonuses are pegged to the price of the market. Goldman Sachs, Morgan Stanley, all these big investment banks, They go around to the best business schools. They hire these guys, these top grads right out of college, to go to work for them and start in the business. And they start them off at maybe 125,000, 150,000 to start, which is not, if you in New York, that's not much. Okay. But the bonuses could be another $100,000 or $200,000. Okay. So bonuses can sometimes be half or more of your entire payout. Now, again, this isn't the case for every analyst. But what I'm trying to help everyone understand is that the bonuses that analysts receive, they account for a good percentage of the entire compensation for the year. 150,000, again, that's not much for a top graduate student in business school. That's not great if you live in New York. But how they get these guys to go work for them is by offering them a great big bonus incentive. Okay. And this year, again, a lot of those bonuses are going to be cut by like 30%. I just showed you the article in the beginning, and that is causing a lot of panic in these institutions, because when the bonuses are cut and you're only getting maybe half of what you were expected to get, then you get investment banks starting to steal talent from other brokerages. Okay. And this is a thing that people don't know. Okay. You get institutions starting, they start trying to get analysts from their rivals, because they know that the analysts are very upset with their bonuses being cut, and they're vulnerable to leaving the company. Okay. Think about it. If you're an analyst right out of school and you're working for some, great big investment bank, and your bonus was just cut by 35% for the year, and out of the blue, you're starting to get a call from headhunters, from other competing banks that are offering not only to hire you, but, at a little bit more pay or whatnot, but they're offering to reimburse you that entire 35% of what your payout was going to be. You're going to, they're going to pay it all back. Now, I don't know about you guys, but if I was cut, $60,000, $75,000 out of my check, and another company is willing to cover that, and I live in New York where the prices are high, then I'm probably going to take the position just to make sure that I can support my lifestyle. But here's the thing. The bonuses are usually tied to the price of the market. Okay. That's where the kicker kicks in. Okay. And this is where you get all the commotion going on, because the investment banks are buying treasuries. They've been buying treasuries to push yields down to get those tech stocks moving up. And tech has been hit very hard since January of the beginning of the year. Okay. The market was down 30% roughly. Okay. Largely due to tech stocks. And now the S&P is surging. We're seeing a surge going on. We saw a surge going on this week because of tech. Now, you cannot orchestrate all of this, all of these movements without yields. Okay. So I'm recommending that all of you keep watching the, here, I'll pull it up right here for you. Okay. Let's get this thing going. Let's pull it up. Where's my mouse? All right. So I want you guys to keep a lookout for the TLTs, okay? Because this is going to be the key, okay? I personally think that they're going to keep pushing the TLTs higher to keep the yields moving lower so the market can continue to rally and move higher, okay? It's a fake rally, in my opinion, okay? And I think come January, it's going to be like musical chairs, and the music is going to stop, and then we're going to see who is left without a chair. We're going to see the real strength of the market, and if all of this was real or if it was just engineering for the bonuses. All right, guys, that's what I'm going to wrap it up here with. I just wanted to, just basically do a quick video and just share my thoughts on what happened this week and why all of this activity is going on. What's make no mistake, it is the institutions that are moving all of the pieces right now, and you don't want to get caught. Okay, so keep a lookout on the TLTs. If you enjoyed this video, if you like, my analysis on the market, you can catch me on my locals community. Okay, locals is where I'm going to be posting, everything that I'm in, what I'm looking at. my watch list, all of that good stuff. It's going to be on Locals. That's where I'm going to interact with the community as well, just like I said in the beginning of the video. I'm not going to really be doing much commenting on YouTube or whatnot. I really want to focus on my community. I want to focus on those of you who really want to kind of learn and have real questions. If you have any questions on a specific stock, now I'm not talking penny stocks, guys. I couldn't give you, I couldn't give you my take on a penny stock because I just don't trade them. I trade, I'm involved and invested in pretty much the S&P 500. Anything that's in the S&P 500, that's what I'm in, the Dow. The institutions have to be behind the stocks. If they're not involved in it, then the stock is not going to move. There's too much manipulation. So I don't do the penny stocks. If that's what you do, hey guys, I'm not knocking you. That's fine. Different strokes for different folks, as they say. Okay. But if you're interested in, and you want to know, hey, what do you think about, what do you think about PayPal? What do you think about, Roku, all of these stocks that got demolished, or the ARK funds? All of those questions will be welcomed in my Locals community. Anything like that. If you want to share something, hey, I just picked up some shares of this XYZ stock. What do you guys think? The community is all going to be on my Locals page, and that's where all the real the real education is going to take place. So that being said, guys, you all have a great weekend. Peace and love to all of you. I'm glad I was able to do this video, and hopefully I'll be able to do another one at least once a week. I want to kind of do these breakdowns. But again, I will be posting more charts and things like that. I'll be more active on Locals than I am on these videos. Hey, this is the start at least. Okay. So again, peace and love, guys. Catch me on Locals. Catch me also on Twitter. Link will be in the bio. All right. You all have a good, exciting week, and I'll catch you guys on the Locals page. Peace, guys.